All right, it looks like we're at time, so let's go ahead and get started. Thank you everybody for joining us today for Around the Valuation World. My name is Chin Chun and I'm with NACB and the Consultants Training Institute. Before we get started, I want to go over a few housekeeping items. First, to obtain CP credit, you must answer all the poll questions that pop up on your screen during today's webinar. CP shipments will be available on the NACB.com portal within 7 to 10 business days after the webcast. CP is only available if you have a subscription to AVW. There is a page with some links in the materials if you are interested in purchasing that subscription for CPE. We do have different with AVW. We try to inform you of all the upcoming topics and hot topics that come up in the industry. However, we are unable to access all of them or have time to discuss all of them. So we do have a link to some other resources where we're pulling from. A lot of it is the Value Examiner Quick Read, the Journal of Forensics and Investigative Accounting, and also the European Business Valuation Magazine, among others. So if you are interested, there are some additional resources available to you. And with that, questions. If you have any questions during today's webcast, please use the Q&A option in Zoom, as they'll be directed to the presenter. If you have any questions about NACBA or technical questions, please feel free to use the chat feature, as those will be directed to me. And with that, I will turn the time over to Alina and Mel, who will get us started today.
Thank you, Shanda. So today, welcome everyone to our March show, to this Around the Valuation World episode. We have a great lineup. As always, we have Mike Gregory with us. He is always keeping us up to date with the industry matters and with all the information that we need to make sure that we do what we need to do and not have any issues. We also have Janae, Castell, and Simon. They are going to be talking about global economic update. And we have Dimitri, he's one of our correspondents, and he will have with him Ken Sanginario, and they are going to be talking about evolving from valuation to value creation, such an important topic. We also are going to have at Mofrad interviewing Will Casserly, and they are going to be talking about navigating 2024, all those strategies that we need for professional services firm, just to make sure that we have achieved the growth that we want. And we'll have Roberto Castro. He's going to be doing and talking about tax court cases that are important in our industry. And we will have Melissa Gragg. She's going to be interviewing our judges. And during this episode, we will also have Dorothy, that she's going to be with us today, talking about discovery and dealing with complex topics using court-appointed neutrals. So it's going to be an amazing show. And now I'm going to leave Mike Gregory. He's going to start doing our industry updates. Mike, great having you as always.
Thank you very much, Elena. And this is what I do. I'm a negotiation mediation specialist. I specialize on issues in valuation, focusing on the IRS and other issues as well as a mediator. Well, we've got a number of articles we're going to go over today. This one is actually a longer article. It's the Valuation Prophecy, Consideration of Post-Valuation Date Information. This is from the Value Examiner that we have here with NACVA. Next one is a major article too, and I'm just going to summarize that in a couple of slides. It's about tax valuations are the main profit driver for BV firms per BVR survey, reviews of surveys on cost of capital data, to be certified or not be certified. This is from Quick Read, and there's an interesting article on that. Survey results from data collection tools and USPAP. Q&A addresses artificial intelligence. So what does the USPAP have to say about artificial intelligence? So objectives for today. You want to apply key concepts related to post-valuation data. And what does that mean? Note the most profitable, fastest growing areas for BV firms. Note the sources on cost of capital. I'll be comparing a couple of those, or two different articles comparing several of those. Assess U.S. tax court requirements for appraisers from a recent court case. Choose data collection tools for security and confidence when you're interacting with your clients with sensitive information. And apply artificial intelligence consistent with what USPAP has to say. So this is a longer article, Valuation Prophecy, Consideration of Post-Valuation Date Information. It's written by Alan Clements. He's a PhD, an attorney, and a CPA. And he's commenting that, we have the standard of known or knowable. What does that mean? And can you use hindsight evidence and subsequent events? That's the question. He runs through the general rule, talking about what was known or knowable. Then he runs through some exceptions related to that. The question is, what is actually foreseeable? What do you know as of the date of valuation that might impact that with future events that might be pending? So you look at available information, what would be considered reasonable to a third party? Is there a standard of what is a prudent person? How about expert testimony? And do they have specific things that they need to follow, or you as a valuer need to follow relative to case law in the area where you're proceeding with your case? May be different in different geographic locations or in federal court, for example. And then confirmation of what are the actual existing conditions. You want to respond to the court with any errors or corrections that you have. You want to address any specific legal or regulatory provisions. Was there a contractual agreement that was either in process or actually is being applied? And for professional standards, the comment from the author is know your standards with whatever you have as a matter of your certification. So whatever your standards are and whatever venue you're in. So I'll just comment, like I worked for the IRS, and I'll say we're working under the standards that are consistent with yours. There are business valuation standards at the IRS. And as a valuer, they might be following, or I would be following the standards as a valuer there. But an estate and gift tax attorney may not. And they may say, well, we're in a certain state. Maybe we might be in Montana or New Mexico or New York or Chicago, Illinois or California. And is there case law in that state that might be different? And they had attorneys assigned to every state that would say, you can look at this or include that based on some court case that might be from that state. So know your professional standards, but there are a lot of other things to think about too. Tax valuations are the main profit driver for BV firms per BV Resources survey. As you can tell, income tax, gift tax, estate tax, that's up from 2018. Litigation support is down about 50%. Transactional M&A, it's down a little bit. Then the other major areas are material matters and fair value. So it appears that work related to taxes is an increasing area for valuers compared to what we had here a few years ago. Review of surveys on cost of capital data. I've got two different exhibits from that article that I put in here. On exhibit number 1, this is from BV Resources. So think about this. It comes out from BV Resources. There may be some bias just because of the folks who are reading BV Resources. And it says that Kroll, cost of capital is clearly the number one thing. And you can see the trend from 2016 to 2023. It's down a little bit. BVR's cost of capital was new. So that jumps up at 35%. It wasn't around in 2016 or 2018. Then the Pepperdine private markets, you can see that's about a quarter. Same with the modern, a little less than a quarter for the SPVI yearbook. Then there are others looking at 2023. Going to exhibit 2. Now we're going with Jim Hitchner. And Jim Hitchner has valuation products and services. And he has a few hundred people who attend his webinars. And so he asked the same kind of question. He came back and he said, Kroll, right now, I'm just going to talk about the medians, but Kroll, 88%. VBR cost of capital, a little lower, about 21%. Modern data analysis also a little lower, 14%. Pepperdine about 10%, and others about 7%. So you can see what others are doing, looking at a couple of different surveys, but they each had different groups that they were including in their survey. Now, to be certified or not be certified by Dr. Alan Needham. Now, Dr. Needham is not certified, but he says, what did I do and how do I remain competent here with the court? And what are things that are a good idea? He says, those not having certification and continuing education are likely not going to be qualified by the court. So he's commenting in quick read and saying for CVAs, this is a definite plus. And having continual education like we're doing right now with Around the Valuation World, that is a definite plus. Then you want to comply with your standards. And finally, you want to be an appraiser that holds yourself out as an appraiser and that you regularly perform appraisals. So if you do 1 a year, would you think that would be regularly? Would a half dozen a year? Might that be regularly? If you do 30 a year, would that be regularly? It's not defined as to what that means, but if you regularly are doing this work and you hold yourself out as an appraiser and meet the other elements in here, you'll be qualified as an appraiser from the standpoint of the U.S. tax court. Then survey results on different data collection tools. So when you interact with clients, you have sensitive information. And for me personally, I don't have any of these tools, but my clients do. So on the different elements that are here, I've worked with ShareFile, SharePoint, and Dropbox. I don't have it personally, but the attorneys and CPAs I work with do, and they send me things that are encrypted. And then I use the same service back and forth with them, but it said on the survey of BV people, what they find out, 78% use some tool of some sort. So that means about 22% do not. But why have the tool? It's for security encryption, branding, shows that you're tech savvy, have confidence in your firm. You can see the different ones that are used there. Personally, Dropbox seems to be the one that's primarily used by my clients, but ShareFile, SharePoint are way up there compared to Dropbox. Then OneDrive, then they had 20% of others, and you can see the other ones listed down below. Now, for those 22% of people who say, I do not use this tool, 55% not using are currently considering using one that aren't using one currently. So that's quite a few people are looking into this as well. And then UsePath addresses Q&A related to artificial intelligence. Well, as indicated in UsePath, there's no substitute for appraiser's judgment. So if the judgment's being done by AI relative to your work, that's a potential problem. Reliance must simply rely on a computer-assisted valuation tool. So you can use it, but it's recommended if you use any form of AI that you state that in your report. And if you didn't use any, it's recommended that you state, I didn't use any form of artificial intelligence. You want to make sure that whatever you're doing with AI, according to UsePath, you're not providing any confidential information that AI can pick up on. There are a couple of opinions here. Advisory opinion 18 talks about automated valuation models. Advisory opinion number 37 talks about computer-assisted valuation tools, which quite likely I think AI would be in that category if you're using AI as a valuation tool. Then there were 2 white papers from the Appraisal Foundation, and I'll have links to those in just a moment. You can read a couple of white papers on this topic as well. Clearly, this is no standard is out there currently, and this is an evolving area. But I think you'd want to make sure that you are indicating you've used AI if you have, or that you have not, if you have not, for whoever your client might be. So here's some additional resources. Here's UsePath Q&A addressing of AI. I just commented on that article. And then here's 2 white papers from the Appraisal Foundation on artificial intelligence. These are up to date with what the Appraisal Foundation has to say. And then here are a couple of bonus items. I didn't have time to talk about these today, but I subscribe to Willamette, and I really like the articles they come out with. They have 3 new articles from Willamette. I'm encouraging you to take a look at those, and that's the link to it. And then Johnson Park VLOM study, it's now available, and that's how you can buy it, $295. I'll be talking about that next week with some of the concerns of the latest issue of that particular publication. Good to use. I encourage you to buy it. And I think it's an excellent resource, especially looking at family limited partnerships. And then to retain good people, give them a purpose, advises Bowerman. And I'm just commenting on that being able to say, what is it we're really doing? And how can we look at this as a bigger picture, help provide purpose for your employees? So when I spoke to the National Grain Elevators and Associated Professionals, that's everything from the big car dealers and ADMs, to grain elevators in Kansas, I commented to them, you're not processing grain. What you're doing is you're feeding the world. Think how that sounds to your employees to say, what we're doing is feeding the world and giving people protein who didn't have protein before, or increasing the protein in their diets. And think about that relative to your firm. What do you do? What is your purpose? He advised, if you want to keep good people around, give them what your purpose is in the big picture, that what you're really doing to make the world a better place. Well, this is my presentation for today. That's my information. I get 2 or 3 calls from people after these, generally within the next week. That's my phone number and email. Feel free to reach out to me at any time in the future. And with that, I'm going to give it back to Mel, and Mel's going to take it from here.
Thanks, Michael. As always good, always amazing information, stuff for us to consider and go deeper on. So, all right, our first poll question's up. If you want to make sure that you're getting continuing ed credit, you want to make sure that you answer that poll question. And let me introduce our next presenter. Janae Castell is a valuation professional. She spends a lot of time dealing with personal goodwill and a lot of complex valuation issues. But she today is going to be interviewing Simon Rubinsohn, I will let you do the introductions, talking about global economic elements affecting valuations. Welcome, Janae and Simon.
Great, thanks so much. And thank you, Simon, for joining us. Tell you a little bit about Simon if you haven't been on for his previous interviews. Simon is the chief economist at the Royal Institute of Chartered Surveyors, RICS. He began a 15-plus year tenure with the RICS after serving as a senior strategist at Barclays Wealth, where he was part of a team responsible for running the multi-manager investment portfolios and helping to develop structured products to widen the client offering. He's a well-known economist and has been quoted in various publications, including The Guardian, Financial Times, The Wall Street Journal. He's appeared on BBC News and Sky News. He's appeared before the House of Commons to provide evidence in the UK, where he is located. In his current roles at the RICS, Rubinsohn is responsible for leading the organization's research and analysis of global property markets. He is also responsible for providing economic analysis and forecasts to RICS members and external stakeholders. So, Simon, if you are there, I can't see you currently. I'm hoping.
Can you hear me?
There we go. Yes. Okay.
Yeah.
So good to have you when you're not busy doing all of that. We're so fortunate to have you here to give us some insight for our evaluations. This first slide here, if everybody is able to see this chart with the surprises indices, would you tell us a little bit about this index and tell us kind of what is the mood surrounding the IMF's projection of growth around 3% that they made back in January?
Yeah, Janie, I mean, I think that, the background is that, and certainly the IMF articulated at the beginning of the year that growth was, picking up from where they'd assumed it might be when they were working through last year, but the numbers were still historically on the low side. And, I've just quoted something from that January document, which outlines the reasons for their caution. I think we're all aware of the dynamics around the global economy and some of the sort of more structural issues around productivity, which are a concern for policymakers everywhere. And I noticed in that earlier presentation some sort of reference to AI. I think that AI is going to be the big bet for a lot of economists. There's a lot of hope here about what this might offer in terms of the global economy going forward. But looking more specifically at what we're seeing in terms of news flow at the present time, what I put on that left-hand side of a chart is the Citigroup economic surprise indices. Now, they do it at a more aggregated level. They do it for individual countries. And these are really indices trying to capture, where the numbers are coming out on a regular basis, very high frequency against market consensus. And, if the lines are above zero, that sort of implies, and it doesn't tell you that much, because if the market consensus is being hammered then by various factors, then you might be beating quite low numbers. But effectively, this is a standard deviation of surprises against the consensus. And on balance, what I wanted to capture is, even in China, where we're sort of generally pretty downbeat about the outlook, you're getting some very modest positive surprises against weak consensus numbers. The US generally has been much better. We all know that story. And Europe is also beginning to emerge after what's been quite a difficult end to last year, perhaps beginning to this year. So I suppose that if the IMF were now thinking about where they might be in terms of their numbers for the globe, I suspect, and we will get an update, I think it's next month, that these numbers will be raised a little bit. But let's remember that they were talking about a 4% average in terms of their assessment of global GDP in the first 20 years of this century. And that, remember, was a period which incorporated the global financial crisis. So if we were to go back to previous periods, it might even be a little bit higher. So the numbers, I think, are improving. But, when we look at it in a historical context, this is still not, the sort of environment we might have been accustomed to in the past.
Right. Great. When the IMF released these global numbers, they also released the US numbers. I think the US growth in 2023 was somewhere around 2.5%. And they're projecting even slower growth going forward. So for the Federal Reserve's meeting, taking those kind of expectations into account, what are you expecting for the considerations to be for this Federal Reserve meeting?
Yeah, well, obviously we've got the Fed meeting this week, and we're going to get an awful lot of discussion around what will be said, what is said, the detail of it, all the dot plots. There's going to be a lot of debate about this, and the numbers around growth and inflation will ultimately be what drives that sort of interest rate story, not just for the short term, but also perhaps for the medium term as well. So when you look at sort of the assessment of inflation, and I think that is the big issue really now, because the economic numbers for the US have, in a global context, been pretty decent. I mean, it's not been spectacular, but this has been an ultra soft landing by most historic experiences, and on a comparative with most other economies at the present time as well. So what is the inflation story? Well, I think, we all sort of knew that perhaps, that real rapid progress in disinflation wasn't going to necessarily get us down to that final, over the final hurdle. And we've all seen references to the last mile of inflation proving more challenging. The last 2 months of the CPI have indeed been that, as I'm sure you're all aware. And Jerome Powell has previously talked about super core prices, because he's trying to look at the CPI and narrow it down to what is really going to be relevant in terms of the PCE, which is what the Fed focuses on. And you can see from this particular chart, and I don't want to go through the detail of it, although in the February CPI, it was transportation, which caused the problem, that green bar. But you can see the month-on-month numbers in terms of aggregate are still quite high, 0.8. The last one was 0.5, if you strip out sort of a lot of the other elements of it. And I think that is the sort of area that there's going to be a lot of discussion around and focus on. Is the real core measure going to come down? What are the factors that are keeping it up? And that ultimately will provide the confidence in markets that this issue is being, is moving in the right direction. Because I think it's not inconceivable to many that, you get inflation down to sort of the 3% area, and then that 3 to 2 is where it becomes so difficult, because that is, that is where a mindset change is required. We've almost got used to some inflation again in the system and trying to really squeeze it out. And from a business point of view, you obviously want some inflation. So, and we are talking about some inflation here. You want that a capacity to allow the economy to provide market signals to the dynamic sectors. But we're still talking about trying to ensure that we move into a sustainable sort of framework for inflation. And I think that is really going to be the emphasis of the comments that we've seen from the Fed governor this week. I think it's going to be very much that it's work in progress still. We're almost there, but we need to get us over this last hurdle.
Would you talk a little bit? I think you may have talked about this in previous interviews, or maybe it's just been in discussions with you and I, but you've talked about this super core number. I don't know how many of our attendees are as familiar with that. So it's stripping away the housing and the energy. Will you talk a little bit about those measures, and if we've got appraisers that are they're going to look and find what the expectations of inflation are? What are the differences? How should they be looking at it and considering it maybe in their valuations? What do they mean? What do we expect to be different from those different measures of maybe PCE, supercore, and more of a broader basket inflation?
Yeah, I think that one of the challenges always with inflation is what to include in a basket. And we also know that the inflation measure is never an inflation rate that affects any particular individual or business for that matter. I mean, these are by their nature very much averages. And when you have an average, invariably, you're going to have something that doesn't necessarily comport with our own individual experience or business experience. One of the particular issues, you mentioned shelter or housing, however you want to define it, how you incorporate that in an inflation index. And it is a substantial proportion of the overall CPI measure, but it's an imperfect measure because it doesn't measure, for example, the price when it comes to inflation to housing. It doesn't measure the price of housing. It measures the owner's equivalent rent, is a phrase that you may have all have heard of. But that in itself is a construct. It's not a market rent indicator. So that we move into the domain of, to some extent, some element of judgment here, and that seems quite odd in the context of trying to capture a basket of goods that you as a business might have to pay, or you as a household might have to meet as well in terms of your normal shopping bills or whatever. So the construct is, makes it difficult to really assess the overall direction, because there are these sort of very volatile elements that are, to some extent, in particular with shelter, a bit of an artificial construct. With food, clearly, just by its nature and reflective of commodity influences, it can be very volatile. So from an appraiser point of view, I think the most important thing is to try and strip out those volatile elements, because while they will clearly be relevant in terms of a headline number, when one's thinking about the underlying dynamics for a business, and what it means in terms of overall policy, it's really getting to the core, which is actually critical. So this is actually part of that process. This is, whether this is the right way to look at it, there are debates about that. But I think that this will give us, and you can see those subsectors, you can try and get an assessment of where the drivers are. You can see, for example, those green bars demonstrate the role of transportation in its influence in supporting inflation, for example.
Right. Okay. As far as the interest rate expectations, you have said that you think it's reasonable to be at like the 3% target rate. And I was watching an interview with the CEO of Bank of America, and he kind of reflected the same sort of expectations. Would you talk a little bit with us about what we can expect in that respect for inflation, for interest rates?
Yeah, look, I mean, I think that the market had got, the markets have at times got really carried away with where they thought interest rates would go over the course of this year. And, I was always skeptical when the markets at one point were talking about six quarter point cuts. That has been scaled back quite aggressively. You can see the sort of comments I've put there on the left-hand side of the slide. And, we're really now perhaps talking about a first cut in June, 3 cuts this year. You've all heard the story. On the left-hand side, you can just see how the Treasury yield curve, even in the last week, has moved up on the back of that sort of inflation story. I mean, I think there's a couple of points that are interesting. That bottom chart shows that corporate bond indices, or the spreads there, haven't actually widened out, despite some of the concerns about, the speed of interest rate declines. And I think, you can put that, you can take, I suppose, comfort from that, in that seems to be consistent with the idea of a soft landing, with companies, not perhaps falling prey to sort of the challenges that you might see in a more significant sort of, in a harder landing type environment. So the fact that those spreads are where they are, and I think another element to this, just thinking about what it means in terms of business, if you look at the sort of business creation at the moment, I think we're seeing, significantly large numbers of new businesses being created. And I think that strong growth in business formation, again, consistent with this idea that corporate spreads are coming in. And you can see we're talking about spreads there on certainly on the, both investment grade and high yield, which are pretty much their lowest in the last couple of years. So, I mean, I think that's quite a positive story from a business point of view. I suppose you can look at where sort of financial markets are or stock markets are and say that's also part of this story as well. And, that's being achieved, despite the fact that I suppose interest rate expectations have been scaled back. I mean, I think it's still right to be looking for rate cuts this year. Inflation, I still believe on balance will continue to edge down. I always thought it would be a harder fought battle. Central banks don't want to be complacent. The Fed certainly doesn't want to be complacent. Jerome Powell's made that pretty clear. He's not alone in that. Central banks around the world don't want to be complacent on this issue. But I think, inflation incrementally is coming down. And I think that will provide the basis for rate cuts. I think it's important, again, from a valuation point of view, to think about where where interest rates are likely to settle. And that's why I talk about this 3% sort of figure. Realistically, we've got to try and, when we're pricing assets, think about what is the medium term sort of equilibrium rate, new normal for interest rates. And I sort of think, 3%, implying 2% inflation and a bit of growth in there does not seem a reasonable base to start from. We can have a good debate about it. Some people may say it's a bit higher, some a bit lower. But I think if you're beginning to frame your discussions around there, that's a good starting point.
Okay, great. What about globally? What do you expect the impacts of the current conflicts to be? What else is going on that we ought to keep our eyes on across the globe for a previews or just for our edification?
Yeah, look, I mean, I think we had a previous conversation about sort of issues, and I think both we probably discussed Ukraine, and then we've discussed the Middle East, and certainly there were fears with the whole sort of Red Sea issue and container prices. What we haven't seen shipping prices or container costs go up dramatically. They have gone up. But, I suppose the trouble is every chart has the COVID experience in there or the post-COVID experience. So when you look at the comparison, this is a relatively small chart. And, I think, yes, there are some higher prices coming through. But if you look at what the knock-on effects on commodity prices are, it's been pretty minimal, actually, so far. Now, again, I use that word complacency. I think I would be reluctant to say that, given that there are two wars going on, that we've seen the end of this and that there won't be knock-on effects. But at the moment, the numbers are still quite supportive. But keep a watchful eye on that, of course. Inflation, clearly, we've discussed it. I believe it's coming back down, but we can't take anything for granted there. Labor markets generally are still quite tight. I can't remember, as a professional economist, any downturn. And obviously the US has, I don't know, the US perhaps hasn't had a recession. If I look at Europe, the situation's rather different. But I even in Europe, even in those economies that have had a harder time than the US, employment is still high, unemployment low. So it's really unusual labor market conditions. So, again, another reason, we shouldn't be, too, complacent about this. Inflation typically would be higher when you have such tight labor markets. And, there are other factors which, in themselves are inflationary. So, we talk about deglobalization, the idea of what, much more use of tariffs and barriers to trade. Typically, that is inflationary. Now, it's very hard to see any reversal of deglobalization. I think that doesn't seem on on plausible, and I think we've just got to watch out for signs that this environment can worsen. I think from a business point of view, one can see at times there are reasons why barriers to trade should be used or could be used or can be justified. But typically for a market economy, it's not. I don't believe it's terribly helpful. I know some people don't necessarily share my view, so something to keep an eye on. I would also say keep an eye on, how the fiscal environment, plays out. It's different in different countries. It's different in the US to Europe. But, we all have much higher debt burdens on the public side of things, not necessarily private debt, but public debt, certainly. And I'm not convinced that, governments on either side of the Atlantic have medium-term strategies to address that. And finally, I think the other thing I would just point to is CRE risks, particularly in the office sector, something to keep another eye on. Polarization between best in class and the rest. We've all heard the arguments. I'm not saying anything new here, but it's something that is going to continue to play out. And, the risk of, assets that are stranded, that can't be used, is something that I think is a very real issue going forward.
Very interesting. I noticed a couple of comments come through. I think mostly agreeing with what you said, that 2% maybe. And then Ron Senior noted, what I think we should, as appraisers, have a good handle on that. We've had artificially low interest rates for a very long time. We've gotten used to it, kind of, maybe complacent, as you've said with that. And it's probably not where the reasonable expectations will be now and going forward. I did want to see if you had any final thoughts on particular supply chain issues, or how we might look at the labor markets, because you mentioned, okay, the labor environment, given the economic environment right now, is unusual. So how do we look at where we are now and differentiate it, compare and contrast it from what we're seeing in the past, to get a better handle, a better gauge for what's going forward?
Look, I mean, I think that the two different issues. I mean, clearly the supply chain issue is one thing. In terms of the labor market issue, I mean, look, historically, we had market. I mean, I think the demographic issue is a major challenge. I think that we've got wherever you look in Western world, there's a focus on a population that may be aging. There's a focus on the role of migration in supporting population growth to help drive economic activity. There's in many cases, and understandably, concerns about how that migration is being managed. There's discussions about the role of AI, the support that AI will provide to growth, and also how it will impact labor markets. There's some big political and economic and technical challenges which all impact around that whole issue of labor. I mean, I think in the short term, we are still going to find that we're quite constrained by labor supply. Investment is going to be a key issue in addressing that problem. I mean, again, it's one of those things that's very country specific. If you look at, say, at countries closer to where I'm located, I think the business investment record is pretty poor. I think it's better in the US, probably not as good as it needs to be, though, over the medium term to drive a higher level of growth. But that's going to be something that is really critical in supporting what are already tight labor markets, because being able to, perhaps support higher participation rates will be helpful, but I'm not sure how successful governments are going to be in driving that. So creating an environment in which businesses want to invest is going to be absolutely critical.
Perfect. Well, Simon, is fascinating and relatable as always. I appreciate you taking the time to help us with what you're seeing and put together some really great charts, some slides for attendees to reference. yeah, so I can't wait to when you're back. I think, is it the end of this year, the third or fourth quarter?
Certainly later in the year, anyway.
Okay, later in the year.
We're giving everybody a break from me.
No, fabulous. Thank you. Great content.
Okay.
As
Yeah.
always.
Nice to
Appreciate
see
your time.
you. Yeah.
Likewise.
Nice. Okay. Bye-bye.
Thank you, Janae and Simon. No, we definitely love having you with us. It's a very difficult topic, but in the way you explain it, it's great. So for everyone, we have our second polling question, so make sure you respond to that. And since you are responding, now we are going to go to another of our session, and we're going to have Dimitri. He's one of our correspondents, and he's going to be interviewing Ken Sanginario, and they are going to be talking about evolving from valuation to value creation. So, Dimitri.
Thanks, Alina. And thanks, everyone, for being with us today. I don't see Ken.
I'm here. Can you
He's there. He's there.
Yeah.
I can
Oh,
see you.
okay.
Yes.
see?
Perfect. And let me share my screen. Thanks again, everyone, for being here with us. And today we are talking about evolving valuation to value creation. And we have Ken here to talk to us about the topic. And Ken is the founder and developer of Value Opportunity Profile software, which is also called VOP, and the Certified Value Growth Advisor Training Program, CVGA. He has over 35 years experience in middle market company as executive officer, M&A advisor, business valuator, and turnaround professional. 18 years turning around distressed company for private equity firms, bank workout group, and business owners. And he has a tremendous baggage of certifications: CVGA, CM and AA, CTP, CPA, ABV, MST, MSF. He's a frequent speaker at national conference and author of multiple articles for technical textbook and trade journals. And he's also instructor on value growth and market readiness for various national association and certified programs. So he's very well grounded in the topic. Ken, I hope I did you justice introducing you.
Thank you, Dimitri. Yes, that was great. Thanks very much. And I should also add that I just recertified my CVA, which had lapsed for several reasons, but it is now restored. So I can add CVA back to my list here.
Fantastic. So small change, big impact. And I also will tell you more about it at the end, but Ken does have a follow-up classes after this. And so this, we'll try our best to wrap up as much as we can to give some meat or some vegetable to a vegetarian about the subject, but it's a great subject. So we'll do our best, but there's a class after this. We'll tell you more about that. So Ken, if you allow me, without further notice, I will just jump on the slide so that we can
Sure.
share the
Thanks.
knowledge.
Yeah, the next session, these 20 minutes are sort of a teaser to the longer session. So I appreciate
Exactly.
the opportunity to share some ideas about how I think the profession can evolve. And this is one of my favorite. There are a couple of graphics that are among my favorites. I use these with clients in engagements all the time. And what I love about this customer relationship hierarchy is it allows any company or any of us, and certainly in this case, I'd like to ask people who are watching and listening to think about your own practice in the context of this customer relationship hierarchy. And the way this hierarchy works is there's a top half and a bottom half. And a company or a professional service provider can be very successful at any point in this pyramid. So it's not that if you're at the top, you're successful, and if you're at the bottom, you're a failure. No, that's not the case at all. It's just a matter of how you structure your practice, how you like to deliver services, how you'll be perceived by your clients, how you'll price your services, and so forth. So if you think about it, on the bottom half of this pyramid, the lower you go, the more of a commodity are the services or products that you provide to the market and to your customers or clients. I would say that kind of right at the top of the bottom half of this pyramid, and I hope this doesn't offend anybody, but I think for a lot of valuation practitioners who are working mostly in what I'll call a transactional method, meaning you don't have any long-running relationships with the companies that you're valuing. You simply conduct a valuation. Maybe it's for some compliance purpose, or maybe it's for some shareholder dispute or something, but you conduct the valuation. It's a transaction. The engagement is completed and it's done. That's the end of the relationship. Maybe your referral sources are where you have the longer running relationships, but the companies themselves that you're valuing are more transactional and short-lived relationships. And so now maybe the lower you go, like I know some valuation firms that they say, well, we conduct 200 or 300 valuations a year because we're doing, these 409A valuations, for multiple private equity firms, and we do the same ones year in and year out. Okay, and those are high volume practices and probably being done with a high degree of efficiency. So the focus is really on efficiencies and cost containment and being a low-cost producer and providing low prices to the marketplace. The lower you go on this pyramid, the more focus your practice is on being a low-cost provider, high volume, high efficiency, low pricing, still very transactional in nature. The higher you go on the pyramid, and if you flip to the top half of the pyramid, that would relate to practices where you're doing probably fewer engagements, but longer running, deeper relationships with your clients, higher priced, not so focused on cost control, but more focused on the impact that you're making, the value add that you're providing to your clients. And pricing, therefore, would also be higher. So on the bottom half of the pyramid, you may have a great reputation in the marketplace. You may have a terrifically successful business, but the price of your services is still one of the primary considerations in you or your firm being engaged. At the top side of the pyramid, the top half, price is secondary, maybe not even secondary, maybe tertiary in sort of the considerations that a client is looking at in order to decide whether or not to hire you for your services. They're really looking at you more as a value-added supplier, somebody that can actually make an impact on their business. And that's sort of the crux of this whole presentation and this concept of how do you want your practice to evolve as a business valuator in the future? Do you want to be on the bottom half of the pyramid and sort of have price and time compression, cost compression be among the key considerations for your firm to grow? Or do you want to be sort of more on the top half of the pyramid, have longer running, deeper relationships, higher fees, be able to make more of an impact, not be so transactional, but be more relationship driven? And that's the kind of crux of all of this. And in my opinion, having switched my professional services years ago, about a dozen years ago or so, to being intentionally on the top half of this pyramid has really made a huge impact on my practice. And I'd like to share with you some ideas about how you can employ some of those ideas in your practice too, if that's the kind of practice you'd like to have.
Fantastic. And I will add that I've noticed that actually as well. I've actually picked up a couple of clients recently who wanted more of a relationship than a transaction, someone who can be with them in the journey. And I'm seeing that shift happening. Great.
Yeah.
So let's talk about understanding client opportunity, if you mind.
Yeah. One more click. There you go. This is another one of my favorite graphics because it's a perfect way it's another perfect way to sort of think about your practice and the context in which you provide your services. And if you look sort of right in the middle of this Venn diagram, that black section, that is sort of commodity hell. That's where any services that you're providing could also be provided by a dozen other service providers within your direct marketplace. And it's very price driven, similar to the bottom half of the previous pyramid. And that is where a lot of our valuation services are kind of concentrated. It's a price compressed marketplace. It's a commoditized marketplace, and getting to be more so as the market demands more and more value for less and less price of our services. Now, some of you may provide valuation services that are sort of in the, if you go straight up from the black section, maybe in the blue-green section, where you may have some competitive advantages because you have some specialized industry knowledge, or maybe you're a specialist in divorce valuations or shareholder disputes or things like that, where, yes, you have a reputation that sort of pulls you out of that commodity section and allows you to be more of a subject matter expert, allows you to maybe have some longer, deeper relationships a little bit, but still more transactional in nature. But it does allow you to generate higher fees for the services because of your special expertise. And your competitors may also, down in that orange space, they also may have some competitive advantages for the special expertise that they have. The big opportunity in this graph is what's in the yellow space. And that's where I think there's huge opportunity. If any of you have ever read the book Blue Ocean Strategy, this yellow area in the diagram is the blue ocean for the business valuation profession, which reflects how big of an opportunity there is in what clients need and want and are looking for. They're not looking for transactional relationships if they can help it. The reason they always kind of accept those is because they're not aware that there's anybody that can actually help them in other ways. And they get bombarded by all kinds of business consultants who are always trying to sell them on services. They don't, to the owners, it's a lot of noise, and they don't end up trusting or believing anybody, and they don't end up acting on any of the advice that they get. But as business valuators, I think we have a really unique position in the marketplace because of our objectivity, because of our technical expertise, because of the knowledge that we can bring to our clients in not only helping them to understand the value of their business today or at some point in the past, in the case of more compliance kind of valuations, but also why the value is what it is and what they can be doing to move the needle going forward.
Yes.
And that, I think, is the huge opportunity for us as valuators to evolve. That will open up our target markets to be much broader than transactional or compliance-based kind of customers or clients, to open it up to literally any company that is operating, because every single company that I've ever seen in almost 40 years now is underperforming in some respect, some a lot more than others. And if we can bring our expertise to them to help them understand all of the issues that are constraining their growth, constraining them from getting to peak performance, constraining their value creation, that's a huge opportunity for us to use our valuation skills in a much broader, much more impactful way, establish longer, deeper running relationships, have more impact, generate higher fees because there's no competition there, and actually have more fun in the process. And I'm going to show you kind of what the key is for making that transition.
Fantastic, fantastic. And what about company-specific risk?
Yeah, the underlying key, the foundation for being able to shift your practice to be more added value is to build up in a more rigorous, more robust way to build up your company-specific risk factor in any kind of valuation engagement. Now, you can use this in a lot of different ways, and we'll cover a handful of them in a few slides. But if you think about company-specific risk as the single biggest factor in developing cap rates and discount rates, and by definition, it is unique to the subject company. And so if we spend the time, the extra time, I was taught years ago, 12, 14 years ago, when I got my CVA and AVV, I was taught there's a safe harbor for company-specific risk. Pick a factor between 3 and 8%, justify it with a few sentences. Nobody's going to argue with you or debate it too hard, and you move on. But to me, that's sort of a shortcut that is a disservice to your clients and can also,
Yes.
I think, hurt the credibility and hurt the usefulness of your valuation report. If you spend the extra time to really dig in and drill down into all of the underlying qualitative attributes and quantify the impact that those attributes, whether they're strengths or weaknesses, have on the buildup of company-specific risk, then you have something that can really transform companies, because you can then use it as a roadmap to help companies allocate their resources, allocate their efforts. And if you think about company-specific risk, it literally is every action. It's everything. It's every action, every decision, every behavior, every transaction, everything that a company does impacts their company-specific risk and impacts their ability to support growth, their ability to create sustainable, predictable, and transferable value. It is the single biggest factor in determining value, in my opinion. And the beauty of it is that it is almost entirely controllable by the business owner with your help as their valuation expert. So you can use all of those underlying attributes that you've identified and help them understand, help them prioritize and sequence the improvement initiatives that will reduce that risk and significantly increase the value of the business.
So I have a question here that one of
Sure.
attendees sent. Are you saying all valuation that include company-specific risks are highly subjective?
I think it is a very highly subjective factor, but if you approach it in a more rigorous, more robust way, you can eliminate a lot of the subjectivity, because you can really drill down and understand your client at a more granular level. And that's the way that you can remove as much subjectivity as possible and have a much more credible, more defensible result.
Fantastic. So can you give us an example of the evolution to value creation service?
Sure. You can, so literally any company right now, I think most valuation professionals, they conduct valuation engagements when a company needs or thinks they need a valuation. But I would suggest to you that literally every operating company out in the market needs to know what the value is of their business, whether they're in a compliance situation or not, doesn't matter. So I'm not suggesting to use this approach, say, in an estate valuation or in a divorce case or something like that. But all of the companies that are out there that maybe aren't even looking for a valuation because they're not looking to exit right now, they're just running their companies, but they all need to run their companies better. They all need to make improvements in order to be able to support future growth, to reach peak performance, to reach highest value, because someday they will need to transition ownership. That may be in the short term, it may be in the long term. So an example would be, let's say you're conducting a valuation, maybe for a company that is thinking about going to market, but you spend an extra day of your time. That's the example here. Let's say you spend one extra day of your time focusing exclusively on building up a company-specific risk factor that's more granular, more robust. Let's say that that day that you spend has an opportunity cost $2,000 or $3,000, which represents the fees that maybe you can't charge the extra fee, or maybe you can. If you can, great. If you can't, then maybe consider that as an investment of your time. But the result of doing so is that you have a higher quality, a higher added value report. It's more credible, more defensible, and it generates a roadmap for you and your client to be able to show your client how they could double the value of their business in 2 to 3 years. And that is, I've seen that many, many times over the last decade, where we've doubled or tripled or quadrupled the values of companies over a 3 to 5 year period. And it all starts with reducing the company-specific risk, which improves the overall quality of the company. And then the natural byproduct of that is that they get natural expansion of their revenue and profitability and cash flows and the value. And if you conduct that one day of additional work, you can generate, just by the client now having a relationship with you, a deeper relationship, a deeper trust, they will engage you now to help them implement that roadmap over the next several years, which could lead to anywhere from $100,000 to $300,000 or even more if you end up managing a transaction along the way or something like that. $100,000 to $300,000 of additional fees for an upfront investment of a day of your time, and maybe foregoing, $2,000 or $3,000 of an incremental fee. And by the way, this kind of follow-on advisory work, I would say typically could be double to triple the hourly rates that you currently charge for a compliance-based valuation engagement that is more transactional based and more in that commodity kind of space. So it's a dramatic change in the way you provide services.
Very true. And can we talk about also value creation applications?
Yeah, you can use this kind of approach, as I mentioned, not only for companies that need a valuation for some compliance reason, but you can use them. So we talked about a business valuation for companies that may be considering going to market to sell. You can use it. Business value growth is the actual implementation of the roadmap. So those are the engagements that follow on. You can use this in M&A advisory services if you do that kind of work. So you can use it on the buy side by helping a buyer to look at a company before transaction or post-transaction. If it's pre-transaction, you can help a buyer understand the risk profile of the company, the target company, at a much more granular level, and understand how much the additional risks or the unidentified risks of the business should impact the offer that they're making. You can use it post-transaction if they've already purchased the company. And I've done this both ways for private equity firms and individual high net worth investor / buyers. In a post-transaction, sometimes you can use this kind of an approach to establish the next several years roadmap for the company. So the buyer buys the company, and now they want to give some incentives to the management team to strengthen their weak areas, improve the quality, and increase the value that way. You can also use it in a sell side engagement in lots of different ways to help sort of pre-market, to help your client understand what they'll face in due diligence if they go to market now, how much value they'll be leaving on the table. You can use this in turnarounds, exit planning. A really great way to use it is in finance strategy. If you're just advising your clients on how to make better financial decisions, capital investment decisions in particular, if they really understand the risk level of their business and the impact on their cost of capital, they can make better decisions. You can use it in private equity firms to help them understand the risk levels across their portfolios. Lots of different ways. We'll drill down into these a little deeper in the longer session later this afternoon.
And no, we are around. Well, we have a little bit more time left. So the more value you add, the more valuable you become.
I don't know whose quote this is, but it certainly holds true. the more value you add, the more valuable you become to your clients. So don't be afraid to invest a little time to add more value to them, because it will come back to you many, many times over.
And I know we're almost out of time, but there's one question that someone asked, and I'm pretty sure you have an easy answer for that. Why will a client be willing to pay $100,000 for next year when they don't want to invest the extra $2,500 today? What would cause them to listen to you or us if they are tone deaf to the value add?
Why would they pay? Because they all need help. If you can give them, if they resist paying additional fees for evaluation because they don't see the value in the valuation report. Typically, the valuation report is given to them. They open up to the page that has the value listed on it, and that's all. That's about as far as they read. They shove it into their drawer and never to be seen again. If you can deliver a value-added report that shows them at a very detailed level how they can move the needle on their company and double the value of the business over 2 to 3 years, that is more compelling to them. And it's something that they cannot easily avoid. And I'm not saying they have to commit to $100,000 to $300,000 right out of the gate.
Fantastic.
What I'm suggesting is you craft some initiatives for them to follow. Maybe you're crafting a 6-month engagement or something like that. Maybe they're investing $20,000 just at the outset.
Thanks, Ken. I think
we're out of
Mel
time.
is already here, so that means
Okay. Thanks,
great
everyone.
topic. And again, there's a class right after today, March 18, at between 3 to 5 p.m. ET, and it's gonna be more in depth. Ken will go through this whole topic in more in depth. So I encourage everyone really who can attend and really get access to this knowledge. Thank you so much, Ken, for being with us today. And
Thanks,
Mel,
everyone.
sorry we went over.
All good. Thank you, Dimitri and Ken. I think this is a hot topic that we need to be discussing, and this idea of how do we transition from a commodity-based mentality to a value-based mentality. And valuation.
And I think you started talking about that
thing
Mel.
out.
Yeah, you've been talking about it for a long time, because I remember way back a couple,
Yep. So good. So good.
Thank you.
And with that, we're going to transition to the next, our next segment, which I think is along the same lines. Ed Mofrad is with us. He's going to moderate the next session with Will Casserly, talking about developing a high growth firm based on the high growth study of accounting and financial services firms and everything. So, Ed, I'm going to allow you to take it away. You've got such an interesting bio. I happened to look at it in more detail, and being in Bangkok and working for the IRS and working for different governments. So welcome to Will. So good to have you on board.
Thank you, Mel, for that fantastic introduction. And I just added an episode to my saga. I ran the LA Marathon yesterday. So you see me sitting here, that's just about all I can do. Believe me, if I got up, I'd be in dire pain. I ran 26.
I'd still be running. They would clock me with a calendar instead.
This was my number 19 marathon. They gave me this big heavy medal for being in my age group and running for so steadily for so long. It's called the LA Loyals. Here I am. I'm still alive, thank God. Thank you for that wonderful introduction again, Mel. And it's my pleasure to introduce my colleague, Will Casserly. And Will, please forgive me if I'm not pronouncing your last name correctly. It's one of those last names that could have several different pronunciations. And since I always call you Will, I never had the need to call you by your last name.
It's Casserly, Ed.
Casserly, okay.
It's Casserly. It's Irish, and we're coming out of St. Patrick's Day. There you go.
And it really is my honor, my pleasure, my colleague, to introduce my colleague, my friend, my fellow scholar. And he's going to talk to us today about how to grow and build our businesses, our brands. And there's a lot to go over, and I know we only have 15 minutes. So why don't you start by running through the first 5 slides that you have. We have provided quite a few informative slides, and then I'll ask you, let me know when you're done, and I'll ask you my other questions.
Sure. Let me go ahead and bring this up on screen, okay? And while we're doing that, also wanted to shout out to Ken. Fantastic points. Love the commodity message, the diagram, and looking forward to hearing more from Ken because I think we're kindred spirits. That's a lot of what Hinge does is researching firms and individuals about how we can differentiate ourselves and go to market. So really excited about our discussion today, though. So today we're going to be taking a look at the results from the high growth study. And we'd first like to thank the association for their continued support of this project over the years. So this is the 2024 edition, and this is the 9th consecutive annual edition of this. Overall, we looked at 824 different firms, and that was split out into 6 different industry groups. And you can download what we're talking about today is the executive summary. You can download it free from Hinge's website. I encourage you to do so. So as I mentioned, today we're going to be looking at the executive summary, and as well individual industry-specific editions are also on the way. For accounting and financial services, there's one for architecture and engineering, consultant, government, legal, and tech. So there's a breakdown and a little bit of something for everyone in the different editions. So let's start off with simple definition. What do we mean when we talk about high growth firms? Right? We define for high growth firms as those with a 20% or better compound annual growth rate over 3 consecutive years. Okay. And we're looking at things what can we learn from high growth firms? What are the primary advantages? Where do they place emphasis on their marketing programs? We're going to be talking about that in the next couple slides. What trends are they paying attention to, right? So when we compare and contrast against their average growth or no growth peers, what can we learn from that, right? There's a lot to this, but we really just want to touch on some highlights today and share those with you, right? So let's start here. When we looked at the high growth segment of firms, we see a substantial difference in revenue growth on the left-hand side here. But it's not just about cost versus the profitability of that, as high growth firms are also tend to be more profitable than their average growth firms. So you're not sacrificing profit over growth rates. An important note, right? So we're going to look at 4 key advantages that high growth firms are benefiting from. And we're going to start with number 1, which is research. So Ed, I know we talked about this and you had a chance to read through the executive summary. Kind of what kind of jumps out at you with this?
Well, the AI, that's a big talk of the day everywhere. AI.
Yep.
How are the high growth firms viewing AI?
So we heard this even earlier today, right? We heard Mike and Simon, right? Both talk about AI. It really jumps out. And here's the proof in the pudding. It's not just what they're talking about, right? It's happening across the industry. And then we kind of get down into the nuances of it, right? What does it mean for professional services? Because it's all just kind of buzzword right now, right? We're all going to be going through this learning curve over the next couple months, next couple of years, right? When we track out in the next, what is the next 3, 4, 5 years going to look like, right? And so the top things that start jumping out of that, right? We think about automation. We think about improved accuracy over things. We also think about, how's that going to affect our billable hours? How's that going to change, right? The average workday is going to change, right? How the way we spend our time is going to be somewhat repurposed, right? So changing roles, changing skill sets, less about technical, mundane tasks, right? And more about advisory skills and soft skills, right?
Do you have the worry like some people do that? I don't know if it's a paranoid point of view, but if it's real that AI will someday enslave all the rest of us. It's going to become so intelligent that it's going to tell us what to do. Do you fear about that?
No. All right, so track back. Let's look historically, and it probably goes back any kind of revolution the world's ever gone through. People probably have the same thing, right? Is it going to be a kind of a buggy whip society, right? think about it the same thing, like track back to the 80s and early 90s when people were talking about one day everybody's going to have a computer on their desk, right? And your computer's going to do all your work for you. It's going to be, the world's going to be like George Jetson cartoons, right? Where like all you do is go to work and press the button and go home, right? And it hasn't worked out that way. What's happened is expectations have changed, right? We're now individually expected to go to work, and we probably produce more in a single hour than our parents or grandparents did an entire week, right? So is AI going to replace all of us? No, but we're going to be repurposed.
I see. So you have no fears about that.
No, if I fear anything, I fear that it's going to be even more work for us in the long as humans in the long run, right?
Yeah.
But that goes with the other thing, like what's going to happen, right? There's going to be a whole nother sub-industry layered into things. So picture AI as a specialization as your job, right? There'd be AI engineers. There's going to be AI people on the administration side, right? So when we're learning about these things, we're not only learning about them for ourselves, for the firms, right? But also our ability to advise our clients, right? And the value. We just talked a lot about value, right? How is this going to affect or increase the value that we're able to bring to our clients, right?
Yeah, because and the reason I mentioned that is because I see the biggest difference between 2023 and 2024 in your chart that you're presenting more than anything else.
Yep.
And do you see any other explanation for that big jump?
It's just the future. I mean, it's for the AI fact, it's just on everybody's mind right now, and it's just the hot topic right now. So let's pioneer forward. We could spend an entire day talking about this, and we will in the future. But let's jump in and let's talk about that first item on here as well, right? The number one issue, even above AI, has been unpredictability in the marketplace, right?
Absolutely.
And so when we think about that, right, like what do we do? Is that just an observation, or is that something controllable? And it is somewhat with data and with research. And so when we look at that, right, we ask, how frequently are firms doing research? And then we split it into between what are the high growth firms doing a little differently than the average growth firms, right? That division of frequency, right? How often firms conduct research changes, right? The high growth firms, if we look at the top side, the high growth firms are conducting more frequent research on a monthly or quarterly basis, right? And our average growth counterparts are more inclined to do that research on an annual basis or perhaps even longer. So what is that? How do we define that? Research is such a big kind of, ethereal word, right? There's lots of different flavors of research, right? There's brand research, right? What's our reputation like? How visible are we in the area or our region or nationally, right? We've got client experience research, right? How does our service delivery rate, right? What's our clients happy? Are they not happy? What do we have to do about that? There's competitive research, right? Is there new competitors out there that we don't know about or ones that we need to deal with, right? Are there things that we could be doing differently or better to differentiate ourselves and stand out? This goes back to Ken's point about becoming a commodity, and how do you kind of hedge against that, right?
Truly a fascinating topic. I mean, one could spend a lifetime really delving into it. That's why we have professionals like you around. Thank you. In the interest of time, we only got a few minutes left. I want to jump down to a few slides, something else that poked at me, and ask you about providing assessments and or consultation. When you go, I believe slide number, I know the numbers changed since you gave me this slide, so I don't want to.
Yeah, we've been talking about it.
But why is this important? And could you talk about that a little bit? Providing assessments, it sounds pretty general.
So let's talk about, all right, so this is our second point, right? Is that marketing itself as a specialty inside of things, we're doing more than just the top of the funnel activities, right? We're not just attracting prospects in, right? We're actually working on the BD side as well, right?
Mhm.
And this is demonstrated in here, right? With some of these top answers, providing assessments, product demonstrations, creating BD material, business development materials. We're here really acting a lot of those bottom of the funnel, like how to close that lead in there. So this idea, the kind of free mini advisory sessions, this one-to-one relationship building, right, is something that's jumped out. And where do we see that? Here's a great stat, right? Between 2023 and 2024, high growth firms reported a 46% increase in adoption of outbound sales calls from internal team members. Right. So things are changing. Even in the short term, even from last year, there's dynamic shifts going on that sometimes we're not fully aware of because it just depends upon how quickly kind of that gets around.
Okay, again, in the interest of time, I want to jump around if you don't
Yeah.
mind.
Sure.
Because we only got very little time left. Marketing budgets. You mentioned at one point that they jumped up significantly since the pandemic. What do you think is the cause of it?
So there's two quick things, right? Number one, there has been a decrease overall in marketing budget spend. Okay. And there could be just a rebalancing. There was a peak during pandemic, and now things may be rebalancing and leveling off. It could be also that firms are a little hesitant, a little uncertain of the marketplace. They're being a little more cautious. So it's getting a little on the low side. It may tick up again a little bit, and we'll pay attention to that over time. Right. One of the other things we look at too is how that relates to marketing spend when we talk about the overall spend, and we also talk about marketing staff, or how many marketers are employed in relation to total full-time employees, right? And we see notable margin over low and no growth firms, right? And when considering the size of the firm, we see, right, there's strength in all three segments. High growth firms tend to employ more marketing staff, regardless of the size of the firm. Right.
Okay, I know we're technically out of time. We're actually gone over. So let me quickly ask you, what is the takeaway? Here comes Alina. Her looks are going to get angry and angry as I stay on longer. So please give us a quick takeaway.
So in respect for time, do take a look at the slides. You'll see in there that fourth priority inside of that is just creating content, and a little bit about what that content is, how that's defined, and the importance of, let's call them the visible experts, right? There's a rise of visible expertise or subject matter experts, and the importance that plays within our organizations. So you don't have to be a rainmaker. You don't have to be a household name to really stand out in your industry. We know that even at the entry levels, the beginning points of that, you really have the ability to move the needle when it comes to lead generation revenue. So please engage in all of these activities. And
very insightful. Thank you. I know I'll be calling upon you with my questions. You play the guitar, apparently. There's a guitar behind you. Unless that's just the screen.
I try playing guitar is like golf, right? You keep trying, but I don't know if you ever get any better.
I can relate to in a golf sense. Thank you, Alina. Sorry we went over by 3 minutes. The floor is all yours.
Thank you both for being with us today. And now we have our fourth polling question. And next, we will have Roberto Castro. He's going to be talking about tax court cases and all of those that apply to us. So Roberto, if you're around. Hola, Roberto. Here. I can hear you well.
Well, Roberto, we still can't hear you.
Can hear you. You're not muted, but we can hear you. So maybe it's your headphones.
Okay, how's that? Can you hear now?
Oh, yeah, now it's better. Yeah,
okay,
perfect.
Perfect. Well, thank you very much. You know what? One thing that occurs to me too is I just finished a book called Super Communicators by a guy called Charles Duhigg. Great book. And basically what it focuses on is on the ability to communicate effectively and what are those skills that are necessary for that. So, we do have the technical skills, and certainly this is one of the emphasis of the presentation. And, as you guys were mentioning, sometimes we do have to have some other additional skills besides the technical one. And reading people and understanding them is a very complicated thing. And I thought this was a real good current book that might be of interest. That said, let's talk about tax court cases. The docket's been actually a little bit on the light side for valuation people. So, given that we have a 15-minute presentation, you've got some PowerPoints. Now, Mel, do you have the control over the PowerPoints at this point, or do you, Alina? Let me see. I guess I'll have control over it, or somebody. So let me see if I
Roberto,
can.
if you can share your screen.
Okay, let me get to the share screen, just spare. And all right, here we go. There we go. Thank you so much. So here we are. We're sharing the screen at this point. So here we go. We got tax court cases for the past year. A few things that I want to keep, that you want to keep in mind when you're talking to a client or else networking, and that is tax court cases. When you see TC, those are usually novel issues, whereas a tax court memorandum usually involves an established issue. These are things that are really run-of-the-mill cases where case law is relatively settled. So let's look at what we have here. Oh, Estate of Huffman. That's really a settled case that we have, whereas Estate of Andrew McElby, that's more of there are some novel issues that are involved there. And then in the last one, William Cecil, that is a case that received a fair amount of publicity and last year, but it's still worth looking at and reading when you get a chance. So again, why do we do this? We do this because we can identify potentially some tax court issues or some issues that may be important to a client. And this is a way to obviously distinguish ourselves and market ourselves and show that we're not just technically proficient, but we're also a little bit more advanced or adept, and we can certainly sell our services. We're not a commodity. So these cases serve as a caution to attorneys, valuation analysts, and also exit planning people that certainly the level of control that a donor has may actually undermine some succession issues or tax issues that they're attempting to accomplish, and doing it wrongly can be costly to them as well as expose the individuals, the attorney, and perhaps a valuation person or professional to some liability perhaps down the line in the form of malpractice, for instance. So review them, share them with the people that you're networking with, and certainly that'll heighten their awareness if they're not currently aware of that. So let's talk about Estate of Huffman. This is actually a relatively recent case. It's a high dollar amount case that's involved here. And what we have is, we'll call him Chet, he's the donor. And the issue becomes taxable gifts that were made in 2007. The question becomes whether or not the exercise of certain rights under a stock purchase agreement from a trust were basically going to be deemed a gift. So this one caught my attention because very often in my practice, when I was actively practicing, by the way, in the course of attempting to retire, but in the course, very often the donors or the parents or somebody is attempting to find a way to retain control over the business, and it's very difficult for them to give it up. So sometimes they'll create additional entities, they'll lease the properties, they will engage in something that's relatively esoteric in an attempt to keep control. There potentially could be a price to that. Second issue is whether the estate properly reported the gains from the sale proceeds of intellectual property, and what is the value of the goodwill in this particular case in the year 2009. That's the last part. The goodwill part is very interesting because they give you a fair amount of insight as to how is goodwill valued and what are the factors that the IRS or the tax court was considering there. So here we go. Regarding the burden of proof, this becomes really critical because in this particular case, usually the burden of proof is with the taxpayer and not with the commissioner. However, in this particular case, there's a really interesting discussion that I think it's worth looking at, and that is sometimes you can flip the burden of proof, and basically the IRS would have to take the burden and prove that their deficiency is correct. So here in this case, the IRS, we'll call it the service, the IRS, argued that Chet's personal goodwill was 0 in the valuation report. Subsequently, they changed the amount that it was, that they came to the conclusion of. And the question became, well, this is a substantial shift in what the argument that's being made by the IRS. And the question is this sufficient for the IRS to have the burden of proof in this particular case? And there are 2 cases that were cited by the tax court as authority as to when is it that the burden will shift. Keep that in mind. These are 2 very useful cases to be thinking about, because it's very valuable if you can do the shifting of the burden. The answer in this case was no. They didn't allow the burden to be shifted to the IRS. So regarding the 2703, so again, there are a number of cases involved in 2703. And in this particular case, the petitioner, the taxpayer, argued that the purchase, so there were some agreements that were entered, and the agreements called for being able to repurchase shares at a certain value at a future point in time. And the question becomes, is that binding on the IRS? And there's a series of tests as to whether or not this was a bona fide business arrangement, whether it was really a device to transfer assets without full and adequate consideration, and is it comparable to other terms? So 2703, again, it's worthwhile thinking about that, reading this case and looking at what are the factors that potentially could result in a business transaction being nullified and being deemed a device. So in this case, with regard to 2703, the stock repurchase agreement was not deemed a testamentary device. Read the case, and I underscore that really importantly. You have a link to it. Just read it. The court found that the agreement appeared to have been a bona fide business agreement, even though there was a fair amount of money that effectively benefited the taxpayer's family. Regarding the comparable agreements, the court was of the opinions that reliance on an isolated comparable is adequate, given that the regulations delineate a safe harbor. So, and it's not an absolute requirement that multiple comparables be shown. Now, I want you to keep this particular, the second point in mind, because in one of the last cases that we're going to discuss, there's a question as to whether or not one comparable, in this case, one guideline public company, is sufficient. And what you're going to do is you're going to, after the seminar finishes, hopefully you'll have be able to gain a better understanding as to when it's a safe harbor, when one single item, or in this specifically, one guideline public company is sufficient or not. The answer is no, it's not sufficient. But in this particular case, when it came to a particular transaction and whether or not it was sufficient, the court actually came to the conclusion that it was actually sufficient to deem it a bona fide business agreement conducted at an arm's length. So regarding the value of the shares, here's where it becomes really interesting, and that is the court actually found that there was a deficiency. So the taxpayer actually did have to pay. But the flip side, what's really interesting is that in this case, the notice of deficiency that was issued by the service valued fair number of shares at $10.7 million. He only paid $1.4 million. So the IRS was arguing that he had a gift of $9.3 million. There were other shares that were involved by spouse, but effectively the agreement that was, or the arguments that are being made here, run over and actually capture the essence of why it is that the court found that there was a deficiency. So the court discussed the use of comparables and instructed the parties, in this case, to adjust the valuation presented by the respondent's expert. I'm going to go further. In regarding goodwill, again, this is something that I mentioned earlier. It's worth reading, although it's noticed as a tax reporting issue. Here, one of the things that occurred was that because a portion of the sales proceeds was attributed to the guy's goodwill, they alleged that it was actually enterprise goodwill. And the reason behind that was that they were attempting to understate the capital, avoid paying a capital gain on the net income under Form 1120. That did not work well. Regarding the accuracy, so again, we know 662, there's a fair number of cases involving that. So because the amount of the shares was deemed to be substantially low, and there weren't, an adequate number of comps that were being used in order to value the shares. Again, it's worth reading because it goes over what is subject to a reasonable cause defense. And again, why is that important? Because the taxpayers will usually say, well, I was relying on Mr. Castro or Mel or Mr. Mofrad's advice, and I shouldn't be subject to a penalty. There are some times when you can use a reasonable cause defense, but not for a number of the penalties. So again, it's worth reading and getting up to speed with that. So again, case came out about just over a month ago. Very current. I think a number of other sources will be talking about this particular case. The next case I'll talk about briefly is Estate of Mackleby. This is from November 2nd, 2022. And in this particular case, the tax court is overruled. So again, bear in mind that even if you appear before the U.S. tax court, you have to make a record in order to have the right to appeal and have a substantial number of arguments that are being presented. And again, make your case because you do have the right to appeal. And in this case, the Second Circuit Court of Appeal reversed the U.S. tax court. And initially, the U.S. tax court held that the decedent's open exchanges, these are for forward contracts. This is somewhat esoteric, but I included that because it's also part of an estate. And this is a liability that was basically that an estate had to pay. And the issue here was whether or not some exchanges of future contracts and forward contracts was taxable or not. Were they actually equal or like kind exchanges that would avoid being deemed a constructive sale of shares? I have a substantial, citation here that's worth again reading, and in essence, what's happening here in this case is that the decedent dies. The estate then is forced to basically pay because they found that the exchange in this particular case freed the petitioner, the taxpayer, from liabilities. And as you read in the bottom line here, the parties have subsequently stipulated that $109 million was owed by the estate as a result of liabilities being freed. So why do I mention that? Again, because sometimes I've had some instances where the parties attempt to get very creative, and there is a sense that they can exchange things, and they can, but you need to be careful. And in this case, it really underscores the taxpayers who engage in that kind of transaction are not always going to get, may have to pay, or the estate may have to pay down the road. What's fascinating here is that there are some doctrines here, and this is where you get really esoteric. Virginia Iron and Hicks, they didn't control the outcome here. They had some good tax counsel that attempted to protect them and say, when there's an exchange of this nature, there is some immunity from that. The tax court found no, the Second Court of Appeals found no, that's not the case. So what are the takeaways here for you? And that is, sure, the tax court can be reversed, was reversed. They had to revisit the issue. The taxpayers actually settled and stipulated as to what the liability was. And so while it's very esoteric, they do have some formulas here with regard to how is it that you can arrive at a value when it's not really clear what is the amount of, in this case, liability that you're being freed upon, which is considered a form of compensation. The last case is a little bit more of what we typically would read in one of the, whether it's BB Resources or any of the other tax professionals or Quick Read, and that is this William Cecil. And this, again, falls squarely in the business valuation area. It's gotten a lot of press, but I thought, you know what, let's just revisit this case just a little bit more. And, you know, for me, the case highlights how this couple engaged, you know, professionals for tax planning purposes. And these are accomplished individuals in the industry, and you can read their names and, you know, see for yourself who it was. And what they did to basically minimize the exposure for estate tax purposes. So what are the techniques? Again, shareholder agreements, that's something that I would imagine if you're involved in a tax practice or valuation practice, you're going to see that. Voting trusts, maybe the average non-taxable estate will not do that. But if you have a taxable estate, then you're going to see a number of Class B shares that are going to be instituted in an attempt to basically retain control and pass on shares that have no voting value or their voting is minimized. Again, good stuff to talk about. The valuation issues, tax affecting. And again, let's review that. There were a number of cases that came out last year that received a fair amount of press with regard to tax affecting. And the question becomes, well, is that something that is still going to be respected? Or is that something I can argue with the tax court? And again, the other issue is the market approach. Is the market approach something that is still viable, or do I have to use the DCF approach when valuing a case? Read them both, especially the tax affecting issue, because that's always a hot button issue. Regarding tax affecting, you know, you've got an extensive quotation here from the court. What method did they choose for this purpose? They chose the SEAM methodology. And the court basically punted in this case. Both the IRS expert and taxpayers experts used these values. The taxpayer came up with a higher SEAM percentage as opposed to the petitioner, rather the IRS's expert. And the court was not really impressed by either of those, or it was not sure that they were going to allow for tax affecting. That said, the quotation, they used a lower figure reluctantly, and they added, there's no total bar, and I'm just going to highlight that, there's no total bar against the use of tax affecting when the circumstances call for it. Now, given that each party's experts totally agree, we conclude that the circumstances of these cases require application of the tax court. And then at the end, you'll see the highlighted part. We do not necessarily are holding here that the tax affecting always or even most often is appropriate in these cases for evaluation of an S corporation. So this is not, again, they're not approaching that.
Roberto, I'm gonna
pull the plug on me in a moment.
Well, not in a moment now, because we're over and I want to get the judges on. I apologize.
Not a problem at all. So there you go. You've got plenty of links. Read the cases and be careful if you do use the market approach. So I'm going to give the control back to you here.
Thank you, Roberto. Sorry about that.
No, you're good.
But I want to make sure that we give the time to the judges also, which is falling onto this. So I'm going to introduce Melissa Gragg, who I'm just going to do it real quick. Melissa, are you on? I want to allow you to just kind of take control and jump in. And we're going to be with Judge Yates, Judge Driscoll, and a special guest, Dorothy Haraminac. I hope I did that right. So, Melissa, take it away.
All right. Well, we're going to give some brief perspectives on kind of what's happening in the court system, and it has to do with utilizing court-appointed neutrals. And so hopefully we'll get Dorothy, and I think we have Judge Driscoll here as well, that are going to provide some insight. But to give you a little bit of context, we're going to talk about, basically how to utilize a court-appointed neutral. And when we're talking about this, we're not necessarily talking about a valuation expert or financial expert. We're really talking about another judge. And we used to call this term was either a court-appointed master or a special master, and we're moving from that language towards a court-appointed neutral. So I don't know if we have anybody else ready.
I'm here if you
I
can
know.
hear me.
Oh, we have Judge Yates and we have
Yeah.
Judge Driscoll. Okay, good. So I wanted you guys to maybe start it off by just giving an example of like a court-appointed neutral and how that type of judge, whether it's a private judge or how that works. I don't know which judge would like to start it off on there.
I'm usually first, so I was wondering. I Judge Yates has indeed not only is smarter and more and wiser. There is a distinction between the two, but I think he has more experience doing this because of the permissiveness in Michigan law relative to New York law, which I think would tie into my point, coming in as the cleanup hitter. So, Chris, could you start? Would you mind?
Sure. What we've discovered in Michigan, where we've been able to use the rules of evidence governing experts to appoint our own experts when we need them. I have typically appointed experts in two areas. One area, which has nothing to do with what you're talking about today, is the area of electronic discovery, where I have a tech genius who I would appoint to come in at the inception of a case and mirror image all the devices so that we'd have final versions of everything and we could send them back to the people who had them. And then the second is I can appoint experts in valuation. Now, I'm a little bit leery of doing that because one of my concerns is in most cases where valuation is an issue, each side is already paying its own expert. And so if I have a court-appointed expert, that forces them to carry the freight for their expert plus the court-appointed expert. But we have that authority to do that. And were I really uncomfortable with valuation principles, I would do that, I would assume, on a regular basis. I view myself as enough of a sophisticated audience that on a bench trial, I'm pretty comfortable hearing from the experts from both sides and trying to make my own decision. But I think it's fair to say that valuation is one of those areas, particularly if you have a judge on the general docket, where if the judge has the authority, the judge might be highly inclined to pick a valuation neutral who would essentially serve as an arm and an eye of the court.
And where Judge Yates just ended is exactly where I'll pick up, which was that critical clause, if the judge has the authority to do that. So Judge Yates was, I think, referring to the authority of the court under what would be the equivalent federal rule of Rule 706 of the federal rules of evidence, which permits the court to appoint essentially its own expert. We don't have that authority in New York. And as Judge Yates said, I don't know if that's the worst thing in the world anyway, because the adversary system is still very effective in rooting out the truth. What the arrow that it takes from our quiver is the ability to save the litigants money by saying, all right, you each could appoint your own experts and we could come to the truth of the adversary system, or it could be my expert. And of course, you could still cross-examine that expert, but you'd save a little bit of money going in. My ability to do that is merely the power of suggestion rather than the power of appointment. Now, as a practical matter, it may well be that lawyers say, well, gee, the judge suggested it. That probably means he thinks it's a good idea. Let's save a little money along the way here. But I don't have the hammer if they say no, or if one of them says no, to nevertheless appoint my own expert. And that extends not only to valuation experts, that also extends to appointing anyone who would be paid any sum of money for any judicial or quasi-judicial function. Exceptions to that are a real estate appraiser, if the appraiser is the asset at issue. Exceptions to that are in custody cases. I can appoint a forensic evaluator. I don't sit on custody cases anymore, but I could back then. But in New York, again, the power of the judge to appoint anyone for a quasi judicial function is limited to non-existent. And again, we don't have the equivalent of Rule 706 in New York State.
Well, and I think that, all of this is good information because it is not only different depending upon the court system, but also the state and the type of court cases. So we'll see court-appointed neutrals in like a family law situation, but they're usually everybody's agreeing to them. And it's a discussion about who's going to be selected that either has some capability, either a financial capability, they're typically still, former judges. But maybe Dorothy, you can give some perspective of how you've utilized, maybe a court-appointed neutral for a discovery issue, or when you're dealing with complex financial issues as well.
Yeah, I'm sorry, and Melissa, before we turn it over to Dorothy, could you just take down that bench book for judges and lawyers on court-appointed neutrals? Because I haven't had the privilege of meeting Dorothy before, and I'm going to multitask and read about all her accomplishments in this 6-point type you have on the slide while she speaks.
Well, I'll save you some time. That one's outdated, so there's some extras, but I'm super fascinating, and you should probably appoint me when you have the power to.
Awesome. All right. Without prejudice as to somebody saying it's not.
No, that's my objective opinion, right? So really, my practice is hyper focused on disputes that are high net worth and super complex. And when I say super complex, I mean cryptocurrency. So all the traditional ways of assessing an expert and assessing discovery get thrown out the window, because now you've got somebody saying, hey, these records aren't complete, and somebody else saying, yes, they are. Usually if those are bank records, we don't argue about that. It's super obvious. With crypto, it's not super obvious. So now, do you appoint your expert? Do you get a neutral to come in? And now the like Judge Yates said, both parties are bearing the cost of a third expert rather than just arguing it out amongst themselves. It's a really difficult thing. And so far in matrimonial litigation involving cryptocurrency, I have not seen a neutral be used effectively. What happens is that a judge is so paralyzed by a decision, and that may be the attorney's fault and it may be like a bad expert's fault, but they're so paralyzed in making a decision about discovery, about whether records are complete, that they delay it to appoint a referee. And what happens then is that the property spouse has a chance to dissipate assets. Because we're not talking about houses, which are a little bit more difficult to move unless they're on wheels. We're talking about stuff that's super easy to move offshore. And so you end up with this time delay in appointing a referee, getting everybody together, getting the referee to make a decision, and then coming back to the court for a decision. And now it's, oh, well, everything's been liquidated and transferred offshore, so now I can't get to it. And that's a big problem. So what I really want to know is, like, what are the words that you guys want to hear to exclude another expert very quickly, early? Because you don't exclude an expert at the discovery phase. So I need you to understand that other guy is a subjective idiot, and you should not be listening to him very early on, like well before we get into exclusion, like at trial. Mm-hmm. And so what are like key words? Like, I'll type it out. So
well, I don't. Yes, that's a great thing about being a judge, right? There are not any magic words. The only magic words not to use in the courtroom, as we all know, are with all due respect, because that means, judge, you don't know what you're talking about, right? So, but short of that, I don't think there's any magic words, whether it's discovery, whether it's pretrial, whether it's trial, that are words that do not exist in Rule 702, which are: does the expert have the qualifications? Did the expert look at a proper set of facts? Did the expert have a methodology rooted in science? And did the expert apply that methodology to the facts? And as we've spoken about in previous ABW segments, Rule 702 was rejiggered as of December 1st of last year, such that it really is imperative on the trial judge to make that decision at the first cut, rather than say, as apparently had happened previously, oh, I'll let the jury decide. It goes to weight, not admissibility. So we got no magic words. There are no magic beans to create a beanstalk. The magic is in the words of 702, I think. And thank you for that question, because it reminds me of, it encourages us to reiterate what we did say last time and what we'll continue to say, which is Rule 702 is really where we ground things. Even in New York, where we don't track 702, those qualifications are very much still front and center for us.
And I would add that if you're going to try to disqualify the other side's expert by filing a Daubert motion, you should do it sooner rather than later for not only the reasons you've described, but this as well. If I disqualify an expert for one side in a case, I'm apt to give them time to find a replacement expert. I mean, it is fundamentally unfair in an adversarial system to allow one side to have an expert and the other side not to have a matching expert. So even if you knock out the first expert as being an idiot, as you say, I would give the other side plenty of time to find a replacement expert who would pass the Daubert filter.
That's understandable. When we're arguing about discovery, right? So now we're well before pretrial motions. We're not even at the stage where experts have been disclosed, but we're arguing through like meet and confer letters, and we're not even yet to like a motion to compel phase. So we're still pre any of that, and I've still got someone who's clearly not qualified put up as an expert. How do you guys like mediate over that? Like what are some of the guiding factors that you rely on? Because you can't use 702 to take that out of your answer.
Right.
Like,
it's in the context of what we're being asked to do. So if we're being asked to police the inability to provide discovery, perhaps because a party lacks a fundamental understanding of what the issues are, our hope would be that the lawyer would send a letter, hopefully influenced by the work of the expert, that suggests there are these problems with the discovery phase, which may be related not just to recalcitrance about discovery, but to a lack of a fundamental understanding about the issues in the case. And that would lead active judges, of which I believe I am one. I know Judge Yates was one when he did trials. And actually, Judge Yates still does some new trials because he has a new assignment also within his current assignment to do some trial work as a judge of the Court of Claims. So an active judge would then call the parties in and say, okay, I got this discrete discovery issue, but at least one side is suggesting a larger issue here. So we might not just be talking about discovery. We might be talking about how you're going to prove the whole case. Can you educate me on that a little bit? So I think your point is terrific, Dorothy, to as the expert to educate counsel about the importance of your role, not just at trial, not just at pretrial, but also in the discovery process. Because again, you're representing a client, and the client wants the best result. The client doesn't necessarily even want to go to trial. The client wants the best result, and your influence and your work as an expert can assist in the discovery process and in the lack of the other side's participation in discovery, just like it would at trial.
Yep, that's exactly right. That's where I find myself these days in discovery a lot of the time.
Mm-hmm.
And what I would suggest to you as well is a few years ago, I was on the committee that rewrote the court rules in Michigan to try to bring them up to the 21st century standards. And we did what the federal rules allow and what more and more states allow, which is, among other things, allow the judge to call a conference on e-discovery at the very outset of the case to bring everybody together to come up with an e-discovery plan. Because what we're all learning is that discovery is just getting away from us. There's so much electronically stored information, and so many people don't have any idea how to access it, to make sure metadata is available and all of that. So if you look in the rules of most states and in the federal system, there is a mechanism immediately to call for the sort of thing you're describing, where the judge, or in the federal system, a magistrate judge, might sit down with everybody and say, let's get organized, let's figure out what we need to get. And if you don't understand, ask the questions now or get somebody who can provide the information you need.
Well, a couple other things, and I think Michael's going to join us as well, and maybe give some of his take. In looking at this, where do you see the most neutrals being brought in right now? Are they really the judge neutrals? Are we seeing expert neutrals? And how could we get involved with that if we were interested, right?
The heart of the case, I mean, when I saw Dorothy's resume include cryptocurrency, I'm reading a book now by Michael Lewis about Sam Bankman-Fried. And as I'm reading it over the weekend, oh my God, Timmy, you don't know any of this stuff. And there are people out there who know this stuff. So I think you need to encourage the judge to know what she or he doesn't know, softly and gently.
Not with all due respect. Maybe
not with all due respect.
maybe
Yes,
disregard.
yes, and that there's not only, Judge, there are things you don't know, but Judge, there's a solution here, and the solution is, the Dorothys of the world.
Right. And I would
Neither
say
is
that
right.
where we struggle most is at the intersection of electronically stored information and complex financial instruments.
Yeah, it's tight for sure. It's almost all electronic now.
Yes.
Yeah, I think you're right. I like that approach.
Well, and I think that the more, Michael will unmute soon, I think the more that people maybe specialize, and you have an expert that, like Dorothy has really gone into crypto, and there's just not a lot of experts in certain areas. That's probably another way to get more found, if you will.
Yep.
Michael, what have you seen in this space?
Okay, what I've seen in this space is that it's really important that when a court-appointed neutral is appointed, that it's someone who really knows the field. And crypto is one field that's kind of been bolded and double underscored as an area that many people are not really experts in. And the role of a court-appointed neutral is not the place to be learning it. They
Right.
learn it. They need to learn it. You have to pick up the phone and call Dorothy, or if there was someone else as good as Dorothy, I would also add their name, but I don't know anyone who has the skills at the level that Dorothy does. Yeah, you have to have, number one, an expert who has the skills and the knowledge and the ability to be that court-appointed neutral. Okay, and also it's important to be sure that the court-appointed neutral is in fact neutral. I've seen situations where the court has asked each side to nominate individuals, and the court made the decision as to which one would be the neutral. And the person who was nominated is someone who had a bias and was doing everything that she could to see that one side prevailed and the other side didn't. And that created a mess that we don't have time to go into today. But yeah, the world today requires more educated, more skilled neutrals.
Well, and I think that Mel has already eclipsed our short time. But it's a great conversation. Do the judges have anything else to offer before Mel cuts us off?
I'm just glad that there's someone out there who can educate us. I'm glad. Thank you. It's nice to meet you, Dorothy, and the other Dorothys in the world.
Yeah, I share all those thoughts, and I recognize the importance of letting people get on with their day. So I'll add.
Thank you all. I mean, as always, this conversation is such a helpful one and an important one for us to have. And your perspective to shine a light on these things is huge for us, because you're in a sense our audience, and if we don't know the right way to conduct ourselves in a professional manner, then we're not going to be as effective. So I appreciate you guys taking the time as always.
Thank you. Thanks for having us. We really appreciate it.
You got it. Thanks, Melissa, for hosting it. And all right, that is our program for today, for this month. We will be back here next month with another program, April 15th, Tax Day. If you want to make sure that you're getting continuing ed for the sessions here, you got to make sure that you're answering the poll questions. Also, you can email headquarters, NACVA headquarters, to get on the list to make that happen. Until then, we'll see you guys next month. Have an amazing month. And if you're in tax season, hopefully an easy one. We'll see you on tax day.